evolving world, why don't we just look at a few case studies that the ITFG had come out with? What we have done is we have looked at the ITFGs, we have looked at financial instruments specific case studies. Some of them could be at the time of transition, but maybe it's still worthwhile spending a few minutes and going through them. So we will cover the financial instruments related ITFG case studies. Right, and some of these narratives are slightly lengthy. We'll maybe take a minute to read them. And in the meanwhile, for those of you who have thought of what the responses are, please feel free and start putting in your responses and what you think should be the accounting treatment. Okay, what's the fact pattern here? The fact pattern here is a company has taken a 6-year term loan and has paid a fee at the time of sanction. The loan disbursement does not happen one shot, it happens in tranches. The question is that, and now let's take numbers to make this simpler. The sanction from the company, so from the bank, was 100 rupees. Fee was, I know it is a very absurd number, but to make calculation simple, let's say the fee was 10 rupees. In reality, if somebody had to pay a fee of 10 rupees to get a loan of 100, you should never lend to that borrower. But in this example, for the sake of simplicity, 100 rupees sanction, 10 rupees fees. On 1st April, the company takes or draws down 50 rupees, and we'll make it simpler. 31st March, undrawn loan is 50. So the question that the ITFG is trying to address is that how do you amortize this fee of 10 rupees? Do you amortize it? If yes, how do you amortize it? So let's take the first question first. Any thoughts on whether you should amortize this? So question 1, should we amortize 10 rupees? Part disbursement has happened. Right. So there appears to be no debate as to whether to amortize or not, and that is absolutely right. We said the principles of amortization are directly attributable and incremental. This processing fee that I'm paying is both attributable and incremental. So absolutely right. No issues around not amortizing it. So we are all on the same page. This has to be amortized. Now step 2 is, how do you amortize? Do you amortize it prorated? If yes, at 31st of March 15, what do you do with the balance unamortized portion? So let's simplify this and say, okay, reduce from borrowings, yes, but do we reduce 5 rupees or entire 10 rupees? When on 1st April. Right, so the question is, I paid a fee of 10 for 100 rupee sanction, only 50 is drawn down. What do I do with the 50? Okay, one good answer is, One answer is entire 10. One answer is balance of 5 and balance over the period of the new disbursement. It has already been deducted by the bank. Sure. Okay. 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 So a good mix of answers. Once again, as expected, a very good mix of answers. Now, deduction is not a debate. What the standard tells us is, to the extent the drawdown has happened, you have to amortize. Now, the logic here is you are paying 10 rupees for 100 rupees of drawdown, not for 50 rupees of drawdown. So you amortize first 5 rupees along with the 50 rupee loan. The balance unamortized fee of 5 remains at 31 March. What the ITFG does is it gives us guidance on how to deal with this. This is subjective. The ITFG suggests you have to make an assessment as to whether the drawdown is going to be likely or not. Now, as management, you may have got a sanction of 100, but you believe, no, I will take only 50 because maybe I'm another 50 rupees some other bank is giving to me at much better rate. So I don't believe this will be drawn down. If drawdown is not probable, then you amortize it over on a straight line basis over the availability period. If you believe drawdown will happen, keep it parked in your balance sheet as an expense incurred in advance or as an advance asset. And that is the response of the ITFG. So assess probability of future drawdown. If not probable, then expense on SLM. So it means yes, 5 rupees will be on the balance sheet. Right? This is a very common example, and I'm sure many of us would have seen these examples. More complex if you're a lender, because you'll have a large number of loans where you're sanctioned 100, somebody is only drawn down 10, but the fee you've taken is on the entire 100. So various possibilities arise, but this is what was the view of the ITFG. And this was discussed in issue number 2, ITFG 10, in case you want to look up the detailed explanation. Okay, this is also a very common one. Maybe we'll see more of these in the coming times. I'll leave this for a minute for everyone to read it. Right, so what are the facts of the case? The facts of the case are, there is a company to which Ind AS applies. They had taken a loan from a bank 4 years back. In 2017, they have availed a fresh loan from another bank to take over the original facility. So I'll take a few names of banks. These are random names that are just coming to my mind. PQR was a borrower. In 2013-14, it went to ICICI Bank, took a loan. In May 2017, it went to HDFC Bank and asked HDFC Bank, why don't you take over the facility which ICICI Bank had given to me? So what will happen is HDFC Bank will pay off the entire money to ICICI. So Bank B will pay off to A. Now, as part of the entire arrangement, there is a prepayment fee that PQR Limited has to pay to ICICI Bank. So there is a fee that for prepayment that the customer is paying to ICICI Bank. Additionally, HDFC Bank or the new bank tells them, when I give you a term loan, I take 1% as processing fee. I will also charge you 1% as processing fee. So the question before the ITFG was whether the prepayment premium and the processing fees both are transaction costs for obtaining the new loan, or are they two separate items? And now I'll leave it open for 2 minutes for everyone to go through the fact pattern again and give their possible responses. We've already got one answer. It says both are transaction cost. Prepayment is not factored in the EIR component. Okay, two different answers. Both are separate, that's right. Okay, prepayment is in the nature of a penalty. Okay. Prepayment will be charged even if it was paid out of own funds. A very valid point. Okay. Okay, I think we've really summarized this very well. Now, there is no, so there are two types of fees as we have rightly summarized. One is the processing fee paid to HDFC Bank or Bank A. That is definitely a transaction cost. It has to be in EIR because it's attributable, incremental. It arises only because I went to that bank to take a loan. With respect to the prepayment penalty, that prepayment penalty is a consideration to cancel or repay the old loan. As it was rightly identified, it's a separate transaction. It would have been paid even if it was paid out or repaid out of own funds. So there is specific guidance of what do you do when you pay a fee to extinguish the debt. That guidance suggests you take it to P&L. So this fee paid to Bank A will be expensed in the P&L or adjusted in the P&L in the gain loss on exchange or settlement of the loan, if any. So the fee paid to Bank A goes to P&L directly. Fee paid to Bank B gets amortized as part of EIR. And that's what the conclusion the ITFG had. Now we'll move to some more examples which are really seen commonly on a day-to-day basis. Comfort letters issued by parent to subsidiary to obtain funds from its bankers. So parent company P has issued a comfort letter to its subsidiary company S Limited. S Limited was able to obtain funds from the banker on the basis of comfort letter. Whether the same will be accounted for as a financial guarantee in accordance with Ind AS 109. Very common question, very common situation. I am sure we would have seen a lot of this. Okay, it is a financial guarantee. Yes is the answer. No is an answer. Right. Let's maybe spend half a minute or 1 minute on what is a financial guarantee, and then let's look at the fact pattern. A financial guarantee contract is a contract which requires the issuer of the contract to reimburse or make specific payments to the holder for a loss that it incurs. And that loss is incurred only when the original debtor does not pay. So in this case, bank is the lender, bank is the recipient of the guarantee. Now, if the parent company is required to pay to bank for a default by S, then that's a guarantee contract. Now, it is important once again that it is an obligation on part of the parent. There is a contractual obligation that the parent has taken over. Once again, the core principles of Ind AS says legal form does not matter. Please look at the substance of the arrangement. Please look at what is there in the document. Don't look at what is the name of the contract. So now the answer in reality is that this is again fact specific. If the conclusion is that this comfort letter creates an obligation on the parent, right? It's a contractual obligation, then you account for it as a guarantee, regardless of whether a fee is paid or not. But if it is only, I am giving comfort, I will pay if something happens, but I'm not undertaking or promising to pay that money, that does not get accounted for as a comfort letter. So that is out of scope. Now this is relevant guidance from ITFG. In the end, the devil is in the details. It's what is written in that comfort letter that will count. If the comfort letter imposes obligation on parent, it is a financial guarantee contract. If not, it's just a simple comfort letter which tells the bank that I am behind this subsidiary S, don't worry. That's all. And there are many cases where we see comfort letters big issue. Some of them disclose them, some of them don't disclose them. The answer is what is the title of the letter is not important. Look at the content. Very helpful guidance from ITFG, because it is eventually a fact-based assessment of the substance of what's in the contract. Once again, we go back to day one. Look at what is in the contract. Don't look at outside. Look at what's in the contract. Right. The next one is also an interesting one. This is again where there will be definite diverse views, diverse answers. Company A has applied for a term loan. As per the loan agreement, it requires personal guarantee from a director of A. In case of the default by the company, the director will be required to compensate. Mr. P, one of the director, has given guarantee to the bank pursuant to which the loan was sanctioned to A. Company A does not pay any premium or fees to its director for providing the guarantee. Question is whether company A is required to account for the financial guarantee received from the director. And we can make this slightly broader. What are the accounting implications of this transaction? Let's look at it in terms of what are the accounting implications. So if there is an implication which is not a number based answer also, but there is an accounting financial statement implication, we should talk about it. So what should company A do in the financial statements is the moot question. Right. So there is no accounting implication, but disclosure is required. Disclosure and the borrowings. Okay. Right. So in this case, what the ITFG opined, right? Sorry, we're getting more responses. We'll wait for a couple of minutes. Direct, right? There is no accounting, disclosure will be sufficient. Yeah, yeah. All the answers absolutely right. What the ITFG finally concluded on this was that it said, look, this is a personal guarantee by the director. Ind AS gives accounting guidance for the recipient of the guarantee, not for the, for the person who gives the guarantee, and no specific guidance for recipient of the guarantee. So there is no Ind AS guidance available for company A. What company A, however, has to see is that two things. One, if it's covered in the remuneration, then that is an important factor to be considered, as was highlighted. Second, there is no accounting measurement impact because the loan is with a bank in a market-based condition. It's a market transaction. So basically, if the guarantee had a value, it would have got factored. Now, however, a disclosure is required under the related party transaction standard. So Ind AS 24 requires that if there is any guarantee given or received from a related party, then that has to be disclosed in the financial statements. So once again, rightly summarized by the group, you will not have a number impact in this, but there will be a disclosure impact in RBT. Okay, the next one is an extension, a logical extension. This time a guarantee is given by a subsidiary to parent for parent's borrowings. So hypothetically, let's assume that subsidiary S gives a financial guarantee to bank for a loan taken by parent P. There is no guarantee fee or commission charged by S from P Limited. Both the parties account for this as a loan on an amortized cost basis. The accounting issues that the ITFG had to deal with are as below. How will the financial guarantee be accounted in the separate financials? They have accumulated losses and have not paid dividend. How would financial guarantee be subsequently measured? How should the financial guarantee be accounted in the financials of the parent? Okay, I'll open the chat box. Okay. P Limited only discloses under guarantee. Issuer to account ECL. Okay. Okay, what the ITFG concluded and the assessment was that in the current fact pattern, there is specific accounting guidance for that is applicable to the giver of the guarantee. So the subsidiary, there is specific guidance that is relevant for accounting. So the subsidiary has to recognize this financial guarantee in the books. It has not charged any commission, but it will have to calculate the imputed commission and recognize this as a notional distribution. So the basic accounting that this entity would have done is they should have received a fee. So they will set up an unearned income, which will be amortized over the period of the guarantee. So the credit goes to the unearned commission on day one, but the debit goes to capital, which will be a deemed distribution by the subsidiary to parent. So I think the key difference between the earlier example and the current example is that there is a principle of attribution, that you are preparing financial statements at a group level. Both holding and subsidiary are a part of your console. So it's an attribution type principle. You are attributing transfer from one to another entity. And that is how the ITFG is also trying to explain this. So it's a, as I said, it's a little tricky one where in the earlier one you did not, but here you are. The logic is attribution. Financial statements of the group include holding subsidiary. That is the difference. And subsequent measurement is you expect what is the impact from an ECL point of view. You calculate the expected loss. If you have to recognize any ECL where you believe you will have to invoke and pay any amount of the guarantee, you book that as an expense. So especially holding subsidiary relationship, invokes that principle of attribution. Therefore, this triggers accounting for both the parties. As I said, this is an ITFG where the outcomes have been aligned that way. Okay, another interesting one. P Limited has INR as its functional currency. It holds debentures denominated in a foreign currency. The investment is not designated as a hedging instrument, hedge accounting, etc. does not apply. The investment is measured at fair value through P&L. The change in fair value of the investment during a period measured in INR terms also includes effects of the change in the foreign exchange rate. The question that was placed to the ITFG was whether the foreign exchange differential is required to be presented separately from other fair value changes in P&L. So would it be required to be presented separately? Yes is one answer. Okay. Right. So the ITFG said that for an asset that is measured at fair value through profit and loss account, for an asset that is measured at fair value through profit and loss account, what you are concerned with is the change in fair value in the functional currency. So you are not required by the standards to do a walk from change in fair value from USD to USD, convert that and say that is a fair value change, and from USD to INR as the exchange rate change. That is not a requirement under the standards. You can take the entire movement and show it as a fair value change. So that is what the ITFG has opined, that you don't have to split. You don't split the presentation. Take the entire change in the amounts which they've calculated in terms of INR and show it as a fair value gain or loss. And this one was ITFG 20. Right, so these were the ITFGs that were relevant for financial instruments. We thought it would be a good idea to have all of them at one place for ease of reference. With that, we finally move to the last technical topic that we wanted to cover. That technical topic is a very critical topic, or is a hot topic, especially challenging depending on which industry you are in. And that topic is expected credit losses.